Welcome to How to Start Investing for Beginners. Watch closely to see how to build wealth consistently over years. The challenge many new investors face is the tendency to react to news or follow others blindly, leading to a very bumpy path and poor returns. What makes a successful investor? What do successful investors know that you don't? And in the last 12 months, my portfolio has had over 26.98% return. This video will give you the foundation to succeed in your journey to 1 million, no matter your starting point. It's easier than you think. In preparing for this video, I've distilled over 100 pages of intricate research and personal experience into an engaging and accessible format. This is not just a video, it's your gateway to financial empowerment. This is the video I wish I had when I first started. Many investors find it hard to make their money grow consistently with confidence. I'm David Harbert, and I provide educational content that helps investors overcome obstacles and increase their wealth, allowing them to achieve their financial goals. I always wanted to get into investing and yet found all kinds of excuses why not to get started. Mostly fear of losing my own money and unsure how to start. My wife, who had been investing for over 10 years, finally came up with a brilliant idea. In 2019, we agreed to a $1,000 bet who could make a higher return from the share market that financial year. Wow, I ended up losing. It was just the kickstart I needed to get started. I have since become fascinated with the process and always looking to learn more. Over the course of 5 months, I've interviewed individuals from various countries and financial backgrounds, adding a rich diversity of insights and perspectives to this content. During my research interviews, the feeling of being lost or confused by investing terminology was regularly mentioned. So let's start there and learn the language. Here are 15 core investing terms that every investor should know, and ones I wish I knew when my investing journey started over 5 years ago. I will be using these throughout this video and reinforcing with many examples to make them easier to understand. Starting with investing, which is a long-term approach where you buy and hold for years or even decades with the expectation that it'll grow and/or generate income. One of the hardest parts about investing is resisting the temptation to pull money out. The big secret in successful investing is leaving your money untouched so that it can work for you. Trading, on the other hand, is a short-term approach where you buy and sell over a smaller time period to maximize returns, taking advantage of both rising and falling prices. This video will focus on investing. Inflation is the general increase in prices of both goods and services over time. Let's look at an example using McDonald's Big Mac. In 2000, the price of the Big Mac was $2.24. Fast forward 20 years, and in 2020, that same Big Mac was $4.82. The primary cause for the price change of $2.58 is inflation. Talking about Big Macs is making me hungry. Security is a tradable financial instrument that holds some type of monetary value. Examples of securities are stocks, bonds, mutual funds, and exchange-traded funds. You may have watched a financial movie such as The Wolf of Wall Street or The Big Short. In these movies, you'll hear the term SEC. This is the United States Securities and Exchange Commission, who governs the trading of securities in the United States. Many countries have something similar to the SEC. Here in Australia, we have the Australian Securities and Investments Commission, or ASIC. Stock is a security that represents ownership in a company. Stock you could own is Apple, Microsoft, McDonald's, and Coca-Cola. Share is a piece of ownership in a stock or security. To put this in an example, here is Cookie Co. For those that know me a bit more, I have a cute little puppy named Cookie. Cookie Co. has available 100 shares of stock. If you buy 10 shares, you would own 10% of Cookie Co. Now, companies listed on the share market often have millions or even billions of shares. At the time of this recording, Microsoft had 7.43 billion shares. Index is a measuring tool for tracking changes in a group of items. Some stock indexes that are commonly mentioned in the news are S&P 500, which is the abbreviation for the Standard & Poor's 500. This is a stock market index that measures the performance of 500 of the largest publicly traded companies in the United States. Dow Jones, which is an index that measures the performance of 30 large publicly traded companies in the United States. Exchange Traded Fund, or ETF, is a basket of securities that can be bought or sold like a stock. So if you wanted to buy the stock of each of the companies in the S&P 500, you could buy shares of each of the 500 companies, or just buy shares of the ETF that tracks the S&P 500 index. Ticker is a unique series of letters assigned to a security for trading purposes. Some examples of company tickers. Apple has a ticker of AAPL. Microsoft has a ticker of MSFT. McDonald's has a ticker of MCD. And Coca-Cola has a ticker of KO. Some examples of an ETF ticker. Spider S&P 500 ETF has a ticker of SPY. Spider Dow Jones Industrial Average ETF has a ticker of DIA. Bull is an investor who expects prices to go up. Bear is an investor who expects prices to go down. Bull market is a time period where share prices go up. Bear market is a time period where share prices go down by at least 20% from the recent highs. Intrinsic value is a measure for what an asset is worth based on a calculation of various inputs, rather than using market price. To recap, we covered these 15 core investing terms. If you feel I missed any critical item for a beginner, please let me know in the comments below. Now that we know the language, let's learn the basics. This section, I will cover 5 basics successful investors know. Basic number 1. Understand what drives share prices to increase or decrease. Demand and supply drives share prices up or down. They are both long-term and short-term factors that drive demand and supply. Intrinsic value from the various aspects of the underlying security health, such as revenue, free cash flow, debt, and more, drive the long-term view of the share price. People assessing these various aspects are doing fundamental analysis. Price trend, which is heavily influenced by emotions of fear and greed, drive the short-term view of a share price. News plays a big role as information spreads quickly on the internet, leading to people talking about a given company as either good or bad, often based on very subjective or biased information. In the short term, share prices do not always reflect the true value of a company. People assessing the price trends are doing technical analysis. Majority of the time, prices are shown using a visual chart using candlesticks to show price movement. This price movement is also known as price action. Basic number 2. Understand what a candlestick is and how to read them. No, not that kind of candlestick. This kind of candlestick. A candlestick is a graphic that represents many useful bits of information in a single visual aid representing a time period. Investors tend to use longer time periods, such as daily, weekly, or monthly. Traders tend to use much shorter time periods, such as seconds, minutes, or hours. For our learning today, green will indicate bullish, rising price, and red will indicate bearish, falling price. We will use 30 minutes as our time period. The opening price will start the candlestick visual. Let's look at an example of a bullish candlestick. At 10 a.m., the opening price is $12.35. The bears start strong and they push the price down to $12.25. Notice that when the price goes below the opening price, the candlestick body will turn red, indicating bearish. Now the bulls kick in and they push the price up to $12.75. Notice as the price goes above the opening price, the candlestick body will turn green, indicating bullish. Once again, the bears take over and they push the price down to $12.65 at the end of the time period. In this case, 10:29 a.m. So in this example, the candlestick is green, telling us the opening price of $12.35 is at the bottom of the body and closing price of $12.65 is at the top of the body. The upper wick, the line above, shows a high price of $12.75. And the lower wick, line below, shows a low price of $12.25. Let's look at an example of a bearish candlestick. At 10:30 a.m., the opening price is $12.65. The bulls start strong and they push the price up to $12.85. Notice as the price goes above the opening price, the candlestick body turns green, indicating bullish. Now the bears take over and they push the price down to $12.45. Notice when the prices go below the opening price, the candlestick body will turn red, indicating bearish. Once again, the bulls take over and they push the price up to $12.55 at the end of the time period. In this case, 10:59 a.m. So in this example, the candlestick is red, telling us the opening price of $12.65 is at the top of the body, and the closing price of $12.55 is at the bottom of the body. The upper wick, line above, shows us the high price of $12.85, and the lower wick, line below, shows a low price of $12.45. Basic number 3. Understand that prices move in wave patterns and not in a straight line. Let's look at 3 charts. Chart 1. Here we are looking at the ticker SPY, which is an ETF that follows S&P 500. Wave up, wave down. 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 Here, we can see higher highs and higher lows, telling us that the trend is upward. Chart 2. Here we are looking at the ticker BABA, which is a company Alibaba. Wave up, wave down. 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 Here, we can see lower highs and lower lows, telling us that the trend is downward. Chart 3. Here we are looking at the ticker NKE, which is a company Nike. Wave down, wave up. Wave down, wave up. Wave down, wave up. Wave down. Seeing similar highs and similar lows tells us the trend is in a consolidation pattern. Basic number 4. Understand moving averages. Moving average is an indicator used to track average price movement over a period of time. There are 2 types of moving averages: a simple moving average, SMA, and an exponential moving average, EMA. In this video, I will talk only about simple moving averages and leave exponential moving averages for a future video. Simple moving averages are a straightforward calculation of the average price. Usually this is over a set number of days using the closing price. I use simple moving average to help determine my buy points. Here's an example. A 5-day moving average, you just add up the 5 trading days closing prices and divide by 5. This shows a 5-day simple moving average of $110. As this is a moving average, each new day brings a new closing price, with the old closing price dropping off. As this continues, a data set is generated. Let's shift to a table to make the data a little bit easier to see. This data set can then be plotted on a chart. I personally use the simple moving averages of 50, 100, 150, and sometimes 200 days on my charts. I always set the color and line type the same so I quickly know which is which. Blue solid line is a 50-day simple moving average. Orange solid line is a 100-day simple moving average. Green solid line is a 150-day simple moving average, and a red solid line is a 200-day simple moving average. So in my charting software, it would look something like this. Basic number 5. Understand price support and resistance. Many times, prices will hit some kind of a level that the price will struggle to cross. Each time this happens, it's referred to as testing that level. The more tests and confirmations, the stronger the level. Investors and traders use this indicator to help determine buy or sell points. Support is a level or a zone that is below a price, and at this level, buyers start to buy, driving the price up. On this chart of the ticker SPY, we can see the price seems to bounce off the 50-day simple moving average. On this chart of the ticker MCD, we can see that around $156, the price seems to be bouncing off. It is important to understand that support is not necessarily a single line. It is really more of a zone. Resistance is a level or zone that is above the price. At this level, sellers start to sell, driving the price down. On this chart of the ticker 3M, we can see the prices seem to be bouncing off the 50-day simple moving average. On this chart of ticker MCD, we can see that around $168, the price seems to be bouncing off. Remember to think of a level as a zone, so when we factor that, we can see more tests. In future videos, I will go into a lot more detail on reading charts. To recap, these are the 5 basics every investor should understand. Know what drives share prices, purpose of a candlestick visual and how to read them, prices move in wave patterns, how to leverage moving averages, and locate price support and resistance levels. If you are finding this video helpful, please consider hitting the like button. Now that we know the basics, let's learn about principles successful investors use. I'll cover 4 principles in this video. The first principle is compounding, which is a repeated process where an investment's earnings are leveraged to generate additional earnings over time. Let's work through an example over 5 years to better understand this principle. To keep the calculation easier, I will use only the initial investment amount of $100 at the start, and an annual interest rate or growth rate of 10%. At the end of year 1, 10% of $100 is $10, so the total value of the investment is $110. At the end of year 2, 10% of $110 is $11, taking the total value to $121, then $133.10, then $146.41, and then $161.05. Now you might be thinking, $161.05, that is only $61.05 after waiting 5 years. This is true when you're looking at small numbers. The magic of compounding really starts to become more obvious once you reach $100,000. I'll demonstrate what I mean. If you start with $0 and invest $833.33 monthly, which is about $10,000 annually. Let's look at how this changes once you get past $100,000. I will use 7% annual interest or growth rate, which is the historical average return of the US stock market, adjusted for inflation. To get to your first $100,000, this will take 7.67 years. Now to get to $200,000, this will take 4.91 years, which is 2.76 years less. Then 300,000, 3.67, then 2.92, 2.41, 2.09, 1.83, 1.58, 1.42, and 1.33 years. See how the time to reach the next $100,000 interval keeps reducing? This is the magic. To make this really clear, to get to $1 million, the first $100,000 will take approximately 25% of the time. The second 25% will get you to approximately $300,000. The third 25% will get you to nearly $500,000, and the last 25% will get you to $1 million. So the takeaway is, do whatever you can to get to that initial $100,000 as quick as you can. If you had $100,000 to start with, to get to that same $1 million would take only 23 years, which is 6.83 years faster. The second principle is dollar cost averaging, which is investing the same amount of money in the same security regularly, no matter if its price is up or down. Let's work through an example over 12 months to better understand this. McDonald's stock, ticker of MCD, on the 3rd of January 2023, first trading day of the year, had a closing price of $264.33. Looking at this chart, the McDonald's stock price fluctuated between $246.19 and $298.41. This is pretty scary with all the ups and downs. Using the same $10,000 annual investment at $833.33 monthly, if on the 1st of January 2023 with the ability to see the future, I would have saved up my monthly investment amount from January through October, and in October, at the big drop, go all in then. And November and December, choose the day with the lowest price for that month. However, as investors, we can't see the future, and timing the market to the best points is impossible. This uncertainty causes investors to question if now's a good time or not, leading to investors following their fears and emotions. Dollar cost averaging helps reduce fear and emotion. As we learned, dollar cost averaging is about consistent investment amounts at regular intervals into the same security. So if we look at the price only on the first trading day of each calendar month, notice how this smooths out the graph over the year. Now, I purchased the maximum amount of whole shares from $833.33 each month. I would add this many shares each month, giving us a total of 29 shares over the year. For this example, to keep things simple, any unused amount each month is ignored. On the 29th of December 2023, McDonald's stock closed at $296.51. This would value our 29 shares at $8,598.79. Using dollar cost averaging, our average share price over that period is $275.17, with a total investment value of $7,979.93. To calculate our return, the equation is value minus invested amount divided by investment amount, multiplied by 100. Let's fill in our numbers from this example. Value is $8,598.79. Invested amount is $7,979.93. Multiply this by 100, gives us 8% as the growth rate. The two big reasons why dollar cost averaging is so advantageous for investors. As the amount is fixed and the timing is predetermined, it removes fear and emotion. It's doable. Anyone can put this into their investing plan. The third principle is diversification, which is spreading your investments across various asset types and sectors to reduce risk. As you select securities to invest in, keep diversification front and center. To explain why this is important, let me review a stock in my portfolio. In 2019, I started to add Alibaba, ticker BABA, as all indicators pointed to a great future and in many cases still point to a great future. During the Learn the Basics section, I covered what drives stock price. Recently, Alibaba has had many events causing fear and concern among investors, ultimately lowering the stock price. Worldwide pandemic impacting people's buying habits. China government announcing investigation into antitrust. Tension between US and China building, with US threatening to remove Alibaba from the US stock exchange. New CEO announced for Alibaba Group. Alibaba announced plans to spin off multiple business segments to focus on a holding company structure. Today is April 2024, and my Alibaba stock is down 53.3%. If I only held Alibaba stock, I'd be really upset and worried about my investment. My portfolio is diversified, and Alibaba is only a piece. So other stocks have performed well and compensated for my Alibaba, and my portfolio is up over 31.25%. Many might ask why I haven't sold Alibaba. That is because Alibaba still passes key criteria of a great business. In the future video, I will go through how to decide if a company meets the criteria of being a great business. Here are some basic rules to follow when managing diversification. Divide up your investment amount across at least 10 to 20 stocks, or choose securities that are already diversified, such as an ETF that tracks the S&P 500. When selecting the 10 to 20 stocks, choose stocks across dimensions so you don't have all your eggs in one basket, such as countries, example US, China, Australia, sectors, example technology, healthcare, financial, types, growth, defensive, dividend, and speculative growth. And when starting out, divide your capital equally among the stocks in your portfolio. Dollar cost average into your predetermined allocation for that stock. In a future video, I will go through how to decide buy points. Discipline to only buy up to your planned allocation amount. Don't sell to lower your allocation if it organically grows more than your planned allocation amount. The fourth principle is have an investment plan, which is a document written down on how you plan to invest. Having this written down in advance on what you plan to do and how removes guesswork from investing. For a person just getting started, this plan doesn't need to be overly complicated. In fact, the simpler the better so you can stick to it. A typical investment plan aligns to your tax year. In US, the tax year aligns to the calendar year, which is January 1st through December 31st, where in other countries this might vary. In Australia, the tax year is July 1st through June 30th. Here are the core items to have in your investment plan. Number 1, objective, specific goal of the investment plan. Number 2, money management, amount of money you plan to invest in the coming year and when. Number 3, diversification rules, number of securities that you plan to invest in and how those stocks will be diversified. This will help determine the allocation as discussed in the third principle of diversification. Number 4, watch list. Define stocks you have either already have in your portfolio or want to have in your portfolio. This is so you stay focused on those stocks. Number 5, entry rules, guidelines that dictate when you will add shares. 6, exit rules, guidelines that dictate when you will sell shares. As an investor, our goal is to hold shares forever, unless a given stock no longer meets that criteria. Number 7, routines. Schedule of activities related to managing your portfolio. It is important to think about each item carefully ahead of time and actually write it down. There is power in writing the answers down. To recap, these are the 4 principles successful investors use: compounding, dollar cost averaging, diversification, investment plan. If you are enjoying this video and don't want to miss out on future videos, please consider subscribing to my channel. Now that we know the principles, let's learn about psychology of successful investors. Psychology is the study of mind and behavior. Here are 10 behaviors to adapt. The first behavior is maintain discipline. To be successful, you must follow your predetermined investment rules. Be very careful not to get sucked into the fear of missing out and making purchases that don't meet your rules. The share market will go up and down. When the price is down, look for buying opportunities and don't sell. When the price is up, just wait for the next buying opportunity. The second behavior is understand before investing. Get into the mindset of being a well-informed investor who is actively engaged in understanding their investments and making decisions based on their own research. Invest only what you understand. Quick test. Is this a company or brand something you personally use? In my case, I wear Nike shoes and continue to buy Nike. If I stop buying Nike shoes, I would ask myself why. Could that be a sign of a company starting to falter? The third behavior is exercise patience. Society is in a rush. To be successful, you need to wait for the right opportunities. Investing is a marathon and not a sprint. As we learned in principles successful investors use, compounding really kicks in later in your investment timeline in a huge way. The fourth behavior is buy gradually, sell reluctantly. Investing is a long journey, and using a principle such as dollar cost averaging to average cost help drive portfolio growth. Stock prices go rise and fall all the time. Stick to your preset rules and wait and wait. The time will come when the stock you want will meet your rules. Selling should be a rare event and really only considered when the company starts to falter, with signs that the company long-term will underperform. This needs to be done with extreme caution, as companies can run into tough times, which doesn't make them a bad company. So do your research. If you find the company no longer meets your criteria, then sell. The fifth behavior is focus on business performance. Set pricing alerts on stocks you intend to buy at your buy points. These alerts allow you to benefit from mispricing without consistently watching the stock market. The sixth behavior is cultivate independent thinking. Warren Buffett has a famous saying, "Be fearful when others are greedy and greedy when others are fearful." Be strong and look at the areas that others are ignoring. Often, this other way is in the long term more successful. It is still important that companies meet your criteria. Buy only great companies. The seventh behavior is avoid market predictions. Stay focused on great companies as they are genuinely resilient in the long term. Most people hate uncertainty, and predictions provide a degree of comfort about the future. Successful investors have learned how to filter out the noise and stay focused. The eighth behavior is disregard geopolitical noise. Every day there are new headlines, such as. The ninth behavior is invest as soon as possible. Know that the sooner you start to invest, the more time your money has to grow and recover from market fluctuations, maximizing your potential returns. Time in the market is generally more important than timing the market. The 10th behavior is turn mistakes into lessons. Accept responsibility for your actions. It is okay to make mistakes. Avoid the sunk cost fallacy by being willing to let go of unsuccessful investments, and don't stubbornly cling to decisions that aren't working. This approach transforms mistakes into valuable learning opportunities. To recap, the 10 behaviors to adapt are: maintain discipline, understand before investing, exercise patience, buy gradually, sell reluctantly, focus on business performance, cultivate independent thinking, avoid market predictions, disregard geopolitical noise, invest as soon as possible, and turn mistakes into lessons. Now that we know the psychology of successful investors, let's learn about the investment strategy for beginners I would use if I started over. Remember from Psychology of Successful Investors, behavior number 2, and only invest in what you understand. To be successful, you need psychology plus strategy. As a beginner, trying to beat the market is very hard. So instead, my strategy would be to ride the market by investing in an ETF that follows an index such as the S&P 500. Let's go deeper into why I said that. Over the last 20 years, the S&P had a total gain of 420.30% and a compounded annual growth rate of 8.60%. In the earlier compounding example, if a person put $10,000 on the first trading day of 2003 and added $10,000 each year at $833.33 monthly, their portfolio would be valued at $584,615 by the last trading day of 2023. If the person only invested in the last 10 years, their portfolio would be valued at $231,954, as the compounded annual growth rate was 12.49%. Looking at the S&P 500 from 1990 to 2023, you can see that every major event has only had a temporary impact. How can this be true? Well, let's dig a little deeper. An index, such as that S&P 500 or Dow Jones, is comprised of selected companies that meet certain criteria. Companies are supposed to grow over the long term. If a company that is included in an index stops meeting the set criteria, then that company can be removed from the index and replaced by another company that does meet the criteria. This is why the index always goes up. Looking at the past 40 years, the S&P 500 index has had a positive gain 77.5% of the time. If we looked at a longer time period and grouped the years by percent gain or loss, you can see that big losses are extremely rare. If I was starting over, I would focus on investing ETFs until I develop more skills around investing, as they statistically have a positive return, are diversified, and easy to get started. Let's combine all this knowledge we have learned in this video so far and write an investment plan together suitable for a beginner. As a quick reminder, here are the sections of an investment plan. Meet Sarah, who is just starting out investing. She's 38 years old, living in Boulder, Colorado, USA. Recently divorced with no children. Has a stable job as an executive assistant earning a salary of $68,000 a year, with an estimated monthly take-home of $4,433. Under the objective section, write down a specific goal of this investment plan. In Sarah's case, she wrote down, in 2024, I aim to initiate my investment journey, leveraging real-world knowledge to build confidence. Acknowledging the inherent risks of the stock market, I view each as an opportunity for growth and learning. I plan to invest $11,400 from my savings, supplemented by $443 every pay cycle. My first year target is a 10% return, which will serve as a benchmark for my future investment strategy. For money management, she wrote down this. One foundational money management item is establish and maintain an emergency fund. In Sarah's case, she is able to set aside $26,600, which is 6 months of her pay using her savings. Next, Sarah plans to use $11,400 from her savings to accelerate her investing. Instead of putting this all in on day one, she'll use what we learned earlier in this video and dollar cost average into her investment, spread across 4 allocations. Sarah has been diligent in the past about setting aside 10% of her pay each month. She will use this $443 to increase her investing portfolio. This table shows her plan each month. For diversification rules, she wrote down this. As Sarah is just starting out, she plans to invest only in one ETF, the SPDR S&P 500 ETF, which is ticker SPY. This will provide built-in diversification while she develops her skills in the share market. The SPY ETF at the time of this video is spread across these holdings, giving Sarah diversification across both sectors and categories. For a watch list, she wrote down this. Sarah will only have SPY in her watch list in 2024 to keep her focused. For entry rules, she wrote down this. Sarah is going to follow the rules strictly in her first year while she builds her confidence. She will only add each month if the SPY ETF is at a support level. If the price isn't at a support level, she will wait until the price does. For exit rules, she wrote down this. As Sarah is only planning to buy into the SPY ETF, then individual companies not meeting criteria is irrelevant. So in her case, there is no exit rules. This will come later when she starts buying shares of companies. For routines, she wrote down this. Sarah's investment plan for the first year is pretty simple, so her routines will also be straightforward. On her payday, Sarah will review the price of the SPY to see if it meets her entry rules. If yes, she will put in a buy order. Otherwise, she will assess what the support level should be and set an alert. This will save Sarah from looking at the stock charts all the time. Once the alert is triggered, she will monitor each day, waiting for the SPY to meet her entry rules. On the first day of each month, Sarah will review her portfolio and assess her current tracking to her investment plan. Essentially, her money management section. I'd love to hear in the comments below if you follow a written investment plan and if it contains these elements. Now that we have an understanding of an investment strategy and a written out investment plan for beginners, let's learn how to actually get started. Here are my 3 steps for getting started. Step 1. Set up a broker. Step 2. Simulation training. Step 3. Execute the investment plan. Step 1. Set up a broker. People tend to get stuck at this step as there are so many options depending on where you are located in the world. My suggestion is go with one of the large, well-known brokers for now. You can always switch later. To get you started, here's a list of well-known brokers. I haven't personally used all of these, so please do your own research. Interactive Brokers, Charles Schwab, acquired by TD Ameritrade, E-Trade, and Webull. Features I would look for in a broker: $0 account minimum fee, a $0 maintenance fee, interest rate on cash balances, and paper trading. I personally use Interactive Brokers as my main broker. I also have an account with Charles Schwab so I can access their Thinkorswim platform, which I prefer for charting. Each broker will have different requirements. At the time of this video, here are the requirements to set up an account with Interactive Broker. Step 2. Simulation trading. Assuming the broker you have selected offers simulation trading, sometimes referred to as paper trading. Leverage this simulated trading to build confidence in using the platform and buying shares. One note, some brokers only allow paper trading to function during market open hours. So if you are located outside of the United States, this is something that you just need to be mindful of. I'll quickly show you how easy it is to log into paper trading in Interactive Brokers. Here's how to log into Interactive Brokers web portal for paper trading.
Okay, if you go to the Interactive Brokers website, in my case, interactivebrokers.com.au, you can then get to the page where you can find the login button. If I hit login, portal login, I can now get to this login screen. Here I can choose whether or not to choose my live trading or my paper trading. In the case of this, I'm just going to show you paper trading, so you can see how it's all turned red to indicate that it's simulated. If I now log in, we are now into a paper trading account. Here we can do all the normal things we would do, except for it's all in a playground that's safe. So if I was to go look for SPY, and I look in here and go, oh, that's a pretty good price. Let me go and buy that one. So let me hit buy. And then on here, you've got to choose a few things. You got to choose the quantity and you got to choose the price. If I just make this one for a simple demonstration today, and then where it says limit price, this is where I put in the amount that I want to pay for this particular stock. And so to keep things simple, I'm just going to use the current price. So if I say 534.64, everything else is okay about this screen, and I just say buy. Now you may get this pop up depending on your particular settings. I'm just going to hit accept. And you can see it's both been submitted and filled right away. Sometimes that fill will take some time depending on what you're trying to do. And then now if I go back to portfolio, we can see I've increased SPY to 2.
Simulations trading outside market hours.
I would do whatever I want to do inside the window. In this case, I just want to buy a share. So we're going to say buy. Where it says quantity, you're just going to change to how many shares you want to acquire. In this case, I want to buy 1. For the limit price, I'll put in the price of the current price, 53411. Everything else is fine for this particular exercise. So hit buy. Now you may get this pop-up, totally normal. And in this case, I've been submitted, and it's noticed that the exchange is closed. Now that's one drawback of the Interactive Brokers simulated account. It only works during live trading hours.
Familiarize yourself with the broker platform.
Okay, so what we're going to do is we need to add our different items that we want to look at in terms of our moving averages. So in this case, we're going to go moving average, and it's going to default it to 9. And what we want to do is go in and adjust this to 50. And then we'll go in and add another one. And this one will be 100. And so on and so forth. So you'd add all the different moving averages that you're interested at. And let's say that I decided, you know what, it's a little bit high for me, but I don't want to go and monitor it every day. What I can do is I can set an alert, and I can choose where I want that alert to be in terms of a price. And so let's just say, you know what, if it gets close to that let's say 520. If it gets close to 520, I want to be aware, and then I can decide whether or not I actually want to buy. So if I click alert, we're going to add another one. And in this case, we're going to say less than or equal to 520, active, done. And now what we've got is we've got that alert in the system. And so basically what's going to happen is anytime that drops below 520, Interactive Brokers will now send me a notification message via email or potentially in your phone, depending on how you've got your notification settings set up. And at that point, you can then dive in and take a look. Again, this isn't about to be perfect. It's about getting that reminder at approximately the price. So that way you can later go in and take a little bit closer look when you've got some free time. So just keep it simple. How we go about depositing funds into Interactive Brokers. To transfer and pay. And I want to transfer funds. And I'm going to transfer into my normal investment account. We're going to deposit funds. And I'm going to deposit in Australian dollar, because that's where I'm based. No, I'm going to do the BPay. I'm going to deposit $10,000. And in this case, if I hit get instructions, what I'm going to get is I'm going to get a whole bunch of information that will later be very useful for me when I'm in my bank account. So I will basically, in my bank account, set up a BPay, which in Australia is just a way to pay into another third party. And I will use the information of this biller code and a reference number as my identification number in order to make that transfer successful. And then it takes about 2 or 3 days for that to come through. But when we're all done, this is where we can click finish and we can go on our day. It's worth noting that the charting software Interactive Brokers is a little bit clunky. And so there's some other options I'll be showing in future videos around a few other ways to do that. It's a little bit easier from a pure charting point of view. I personally only use Interactive Brokers for buying shares, not necessarily for doing any of the charting or investigation work.
Step 3, execute your investment plan.
And I have multi-factor authentication in place, and so I'm going to have to accept this on my phone. Okay, so now that we're logged in, you can see my account, and we're going to do a lot with SPY today. So if I go to portfolio just to see where I'm at, we can see SPY I currently have 22 shares. Let's go and search for the name SPY, or we could search for the word Apple. All right, you basically just choose that ticker symbol and that will take you to that particular share or security. But in this case, we're going to play with SPY. So I'm going to go to SPY. Now it may pop up, what things do you want to buy? In our case, we're looking at stock. And then on this screen is where you can do all kinds of things. Now, as we can see in this case, it's recently gone below the 50 moving average, and now it's currently above the 50 moving average, which is okay. Now, would I necessarily buy here? It depends. In this case, it's a little bit away from the moving average, so I'd probably not buy based on the buying average, or the moving average. But if I look at other items as well, it's also kind of hitting what might be a bit of a resistance. It's hard to say yet, but because we're also looking at dollar cost averaging, I don't want to get too carried away in here. The difference is if we get it closer to a buying level, like a support, or potentially following one of these moving averages, it just means that we've got a little bit more percentage that we might earn over time. But again, let's not get stressed out about that as a beginner. It's really about understanding how it works. And if you find that it's way outside, so if we go and pick something else, like Apple, we can see that it's way above the moving average. This would definitely be what I would not buy at this stage. But for the SPY ETF, because we're going to dollar cost average in, it's less of a concern. But this first exercise, I just want to look at buying one share. So notice on this page, it allows us to choose which account we want to take the funds out to make this purchase. In this case, I'm going to choose to just make one share, and it's already populated the limit price. And I'm going to say buy. And it'll say the order has been canceled, and that's because it's currently outside of market trading hours. To get around this, for people like in Australia, we can do that same activity. Same price, but now we're going to say outside of regular trading hours, yes. And now if I hit buy, it can be both submitted and filled if there's the availability for that particular share to be filled outside of trading hours. And so now if I go back to portfolio, we will see my buy has increased to 23 shares. We've successfully purchased one share.
As you get more comfortable with investing in the share market each year, you can enhance your investing plan and build on this foundation to generate $1 million portfolio or more. Remember, successful investing is a journey and not a destination. I provided a link below to my free beginner's guide to investing, so please check that out. That's it for this video. Thank you for watching. I would love to hear your comments on this video and any future topics you'd like me to cover in the comments below. If you enjoyed this video, please consider subscribing and click the notification bell to ensure you don't miss out on future videos. Until next time, may the markets be with you. I'll see you in the next video. Bye!